All right, so this is the Zeus Bootcamp Advanced, and today we're going to be talking about institutional trading. And institutional trading is one of the most powerful forms of all trading because the largest market participants trade in the Forex market, the crypto market, the stock market, and all the other markets the same way. And they use these same mindsets in all markets. So institutional trading goes just beyond the Forex market and to every other market. So what I'm going to talk to you about is, one, who moves the markets? Who are the biggest players in trading? Because price moves when a lot of orders are met, and a lot of orders are made with the bigger traders. So we're going to talk about who moves the market. We're going to talk about retail trading versus smart money concepts. The intraday market cycle, so how the market moves, the schedule of the trading sessions. Then we're going to talk about the components of institutional trading, which are supply, demand, liquidity, and liquidity grab candles, and mitigation, imbalance, points of interest, institutional entry, stop loss, institutional trading with market structure. So this is going to be, a pretty high value video. And for people who really want to understand the markets and really be dynamic in trading, definitely make sure you watch this completely through. So let's start with who moves the markets. The main players in the markets are not who you think it is. They are not, you and me. They're not small groups that trade. They are the big banks, institutionals, hedge funds, firms, different aspects of that. You can actually see here that what's called interbank Forex markets. It's the markets we trade from. So the primary interbank currency market participants are going to be your market makers, your Forex brokers, your electronic Forex brokers, central banks, smaller financial institutions, hedge funds, multinational corporations, and high net worth individuals, which actually are the smallest part of this group. If you look at the percentage of the top 10 currency traders in the world, you notice that there are, JP Morgan Chase overall volume percentage is 10%, almost 11%, UBS 8%. Here's the thing, I'm not going to just list all the banks. You can see which banks they are and which groups they are. These are not, you and me. And so if you think your standard lot size, your standard 0.1 lot size is moving the markets, that the markets care about your positions that you place with those sizes of trades, they are not worried about it because those are not the major moves in the market. Those aren't the major players. So, for people who think, the bank, my broker is just trying to get my trading, your trading's not large enough for them to care. And that's the biggest mindset with that. So retail traders, if you think about, those retail traders, these are your everyday traders just like you and me. You see right here, they participate through brokers and banks, retail brokers, which are largely controlled and regulated in the US. But they have basic education that most people follow. So you see that there's a lot of different educational platforms. If you Google Forex trading strategies or indicators, you'll see some of the same things pop up. Now, you can take it back here. The reason I'm bringing this up is that when you have a large group of people trading the exact same way, it's easy to see through that. And you think about, if you go back, these retail traders, the main thing you want to pay attention to is they trade through brokers. So if all the retail traders are trading through brokers, what can brokers see that other retail traders can't see? And that is the stop loss, the entry orders of every person trading within that network. So if you could see where people have interest at, wouldn't, bigger firms, banks find some way of taking advantage of that information? Even if it's not your broker, the banks may have the access to those order books. So what happens is, let's move it over here. Let's say you're doing a basic strategy, right? So you have your consolidation. And what do most people do when it comes to consolidation? Well, they create little support resistance, just like you're taught in just about every trading course, your support resistance that everybody knows about, that everybody can see. You're not the only one who can see this support resistance. And, two things are happening. One, you're seeing where you can place your trades. The second thing, who's also seeing where you're going to place your trades, are the market makers. And the market makers have access to all the order books from all the individual traders. So if everybody is looking for this break and retest trade, say the market breaks out, goes here, and people are looking for that continuation forward. If everyone is looking for that trade, the market makers could possibly do something to where it'll stop you out. Let me tell you why. Why would the market makers want to do this? And it all comes, I'm gonna skip around just a little bit, it all comes to the fact that, I'm just gonna introduce this. When it comes to trading, trading is basically about supply and demand, just like other forms of economy. And if everyone that's in the market wants to sell at one level, who's going to buy on the other side? Because it's a trade. To sell, somebody must buy, and to buy, somebody must sell. So, but what happens when everybody is aligned in the exact same thing? Then the market really doesn't move, or more so, the larger institutions can't place their orders because there's not enough buy or sell orders, whatever they need to get into the market. So what normally happens is the market makers, they use forms of manipulation versus like more so moving price by placing buy orders and sell orders, or creating enough indecision in the market to where there's enough people placing the type of order that they would need to place an order in the opposite direction. So there's enough people placing sell orders to place buy orders. So in this example, if a lot of people are selling here, that gives the market makers an opportunity to buy and move the market up like this, stopping everybody out. So that's just an introduction of it. I'm gonna go into it later in the video. So the intraday market cycle. The market cycle is basically where, and this is something that a lot of people don't teach or don't know, is that the sessions of the market pretty much repeat themselves as far as how they move. Not necessarily what direction they move, but how they move. So if we go here, let's say we have a downtrend performing here. Then you have consolidation. Then from there, the downtrend continues. Something simple, just so we can understand what's going on. The different sessions in trading do different things. So we're going to separate this out with this white line. So we'll start here. This session was a New York session. In earlier videos, you know what time New York session is for you. This session is the Asian session. This session would be London. Now, why did I put this type of price movement in with these sessions? Well, if you look at the markets, and we'll see some examples in a minute, you'll notice that the sessions repeat themselves. So a lot of times during Asian sessions, especially for non-Asian currency pairs, is the market will go into a consolidation form. This is commonly called the Asian session range. In this video, what's most important is to understand why this range is happening. Beginning of Asian session is the Forex day change. So like, the changing of the guard when you think of brokers, because the brokers are switching shifts, or the market makers are switching shifts or swapping over the order books from yesterday to the new day. So the beginning of Asian session is that Forex day change. What Asian session commonly does with this consolidation, you have to understand what consolidation truly is. And consolidation is accumulation of orders. And this is why the Asian session range is accumulating orders. What is everyone taught to do in a ranging market if you're going to trade it? And that is to, buy low and sell high. So if everyone is placing orders in these positions here, so if everyone is placing orders here, they say they're placing a sell order. So if one group of traders caught the first entry, they're still in that order. Another group of traders think it's going to buy from this point and reverse. So they bought here, forcing the market to go back up. And then another group of traders started selling here, making the market drift back down. And it's just this accumulation happened. That's why the price is moving up and down, but they're moving up and down in a small way because the major players haven't really entered in the market yet, or at least not in a big way. So what's happening is each one of these little moves is being created by buy orders and sell orders. Why is this important? Because like I said before, there needs to be enough orders in the market for a large player to place a trade for the market to move in a big way. So if somebody places a sell order, where would their stop losses be? They would be above here. They would be above that range. So this is what the brokers are seeing. They're seeing a bunch of people enter stop losses in these areas. So that is accumulating interest, accumulating liquidity. This is what's happening. So if these are sell orders, here's the secret about trading in general. A stop loss to a sell order is really a buy, and a stop loss to a buy order is really a sell. So what the brokers see it as, or the market makers, they see these areas as buying interest. But nobody is buying in this area because everybody's selling because they want the market. This is the top of the range, and a lot of people are agreeing that this is the high in the market to sell. So everybody's selling there. So if nobody is buying here, but everybody's buying there, but the bigger institutions want to sell, what would have to happen to create the movement that's necessary? Is the market would have to get into this range here where all these stop losses are and grab into all of these buy orders, these selling stop orders or buy orders, and create a movement down. Create a movement down. And this is the movement that'll happen to continue that downtrend. So a lot of times, those double tops or double bottoms, they're used to exploit trade entries or to induce traders to buy or sell at those levels in order to create this accumulation of orders that can be later used upon. So the Asian session is mainly used for that purpose. This little movement here is commonly called the expansion or the contraction. The next move is the expansion. Okay. And this is when the market breaches the range to, I call it, squeeze the orders out of the market. So that's what's happening here, is that the market breaches that range. And then this area is that continuation, or what's called expansion. And that's why you see a lot of times during London session, there's a bigger move that happens. And to capitalize on these moves that were made at the end of the day, or the beginning of Asian session, which is the early part of the day. New York session usually is a continuation of that expansion. Either a continuation, so put it here, a continuation of the expansion, or, if that was a downtrend, or it could be a point of reversal. So New York session kind of has like an option A and an option B, or a reversal point. A lot of times reversals will happen during New York session. So the Asian session is usually meant for accumulation. Then there's a contraction that happens in the end of Asian going into London. That in London is usually that expansion. And the New York session is usually the continuation of the expansion or reversal of the expansion that was made during London session or for the week. So if we look here, let me put the session breaks back on. So basically these dotted lines is the start of Asian session. Let's go to a basic pair, because sometimes Asian pairs move different during the Asian session because they're Asian pairs. So Euro USD, notice when Asian session starts. The Asian sessions from my time, 4 p.m. to 1 a.m. So that is the Asian session for this particular day. Notice if I'm gonna keep just marking up the different Asian sessions. Notice that the bigger movements don't happen during this session. Move this out the way. It's usually smaller contracted movements. A lot of times consolidation. You notice just about every time there's a counter move that happens before the major move. So okay, that should be enough examples. Yeah, so that should be enough examples. So, and it doesn't happen, those counter moves don't happen every time, but they happen a good number of times. And this is what I mean. In this London session here, this move down, that was started after there was a slight move up here. So I'm just highlight that in yellow. That slight move up. That was, if we go back to our diagram, that was our contraction points right in here. That contraction that leads into London session. So go back to Euro USD. You see here that contraction was right there. And then you see here for London session expansion. Same thing happens the very next day. So you have the bigger move was the up move. You see that this move came down. That was your contraction to get into the liquidity present at the time. So that was the contraction. And then this move here was the expansion. That was the London session. So you notice that change. So that right there was London session. Let me change the color. Nope. That was London session. And then you see how New York basically continued that expansion. So that continuation, that's what it did on that particular session. We go here, London session being into right here. So this red would be London session. That London session expansion, notice what happened during this New York session. There was a reversal. There's a reversal of that expansion. So this New York session did a reversal. And you can literally keep following the market while it makes those moves. And the cycle is just going to repeat itself. So that was Asian session. This was London session here. Oh, actually. That's Asian session. You know, in this one, it didn't have that expansion. It just decided to just continue down. There wasn't no action expansion. The contraction. There wasn't no counter move leading into the big move. Like I said, it doesn't happen every time. But notice that's London session. And then New York just continued that movement. And you see it just repeats itself. This was London session. You know, it expanded out. And this was New York session. Had a reversal. And for time's sake, I'm not going to go through and label everything. But you see the point. At the schedule of sessions, every session is going to have a movement that follows that pattern. Like I said, the direction may change, but the pattern still stays the same. So relation. I'll just make sure I labeled that last one. All right. So that's that aspect of it, the schedule of the sessions. So for the intraday market cycle, so the components of institutional trading, you have supply and demand, you have liquidity, you have the institutional candles, mitigation, and imbalance. Now, those 5 ideas are the main points of emphasis when it comes to the components of institutional trading. There you go now. So we're going to focus on these next few things. So supply and demand. Supply and demand is simply what it is as far as definition goes. What price in the market creates a lot of supply, and what price in the market creates a lot of demand. A lot of people don't teach you. A lot of people just say supply and demand, support resistance. It's not the same thing. Supply and demand is beyond just support resistance. So if I was to draw what supply and demand would look like, this is what it would be. Let's do this. So you have your high price here, high price range, or the higher side of the price range. And then here at the bottom, let's copy that. Here at the bottom, you would have your low price, or bottom of the range. In the middle, you would have your fair value. A lot of times at fair value, you have what's called market equilibrium, meaning there's an equal number of buying and selling going on, creating consolidation. So if we were to look for selling, a lot of selling would happen when the price is high, because sellers are wanting to, this red basically indicates sell interest. The bigger the box, the more the selling it, the more the interest is. So like literally in these aspects, the top of the range would basically contribute to more selling. But as you get towards the middle of the range, the middle of price, we can make this a little bit bigger. There we go. You start to see something different. you start to see lower amounts of transactions going on, and then there's an equal number, there's a closer to equal number of buying and selling going on in these fair market avenues, these fair market levels. So when you have, this going on, this is what your supply and demand is going to start to look like. As you get to the lower prices, people are going to be more inclined to buy. So when you have these larger ranges, or these ranges that happen, this is what it looks like. Top of the range, more people sell. As you get lower, the selling interest is not as high, starts to go down. And then the dominant interest in the market, once it gets past fair value, below fair value price, is now there's more buying interest going on. So this is what you see in the markets all the time. I'm going to show you how to notice that difference. So here's what happens as far as price movement with supply and demand. As price moves into that level, you may have, from here, you may have buying, uptrend, a little bit of slowing down because this is the fair market price. But then the buying continues. You have basically, you have an uptrend. I know that's not the prettiest, line, but as that uptrend gets to that critical point, that climax, that selling, there's the buying interest stops because the price has gotten too high to buy a lot of. And the people who have bought from down here are looking to now take profit because they bought at the low part. So you see that reaction happened at the top of that supply range, because this is the bottom here represents demand. That way you know which is which. And the top here represents supply. It means people are selling. So as price reaches that top of the range, that's when that pivot happens. So when you look into the markets here, you can notice that this here was the top of the range. The supply happened here. See that fast reaction down. This was a supply zone. And here was a demand zone. Why are these that point? You notice the reaction when price reaches there. You see how that was a sharp reaction? Then down here, price immediately reversed and came back up. So when you see this, think of this over here. This is what's happened now in the middle price. In the middle, in the fair market, two things happen: either consolidation, which is the main thing, so fair market. So consolidation happens in those middle levels. You see, if I just make a line, let me just do that real quick. Make a line in the middle of that top and the bottom. You notice that there's consolidation at that point. Believe me, I can go to another area, top and bottom of a range. So we'll just use these two. So it's the top of the range here, the top of the range. This is the bottom. So we're going to make that green for demand, people buying. We'll make that red for people selling, top of the range. And I'll even use a Fibonacci to measure out that 50% point. 50% point is here. So I'm going to change that to white. Notice around that area, fair market price or consolidation starts to happen. And see, when I return to that area again, more consolidations happen. See, more consolidation, but that was a range I picked out from way back here. That's why demand, supply and demand zones are so important to know, or to have an idea of, to have an idea what's the supply, what's the demand zone, what's in the middle. So the reason I taught you this is because the next form of institutional trading, the next component of it, takes advantage of supply and demand. And I'll show it to you. So the easiest way to, let me clear this up. So let me find a clear spot. Okay, so liquidity. We talked about multiple times the market makers moving into certain zones to capture enough orders to place their trades. So the aspect of liquidity is the question of, you asking yourself, if I was a market maker, where would I be looking for the money? Like, where's the money? That's the question you ask yourself. So when you have these consolidation points or areas where it's not always consolidation points, but this is the easier way to explain it. When you have this area where a lot of people are buying or selling based off of common strategies in the market that retail traders trade, the market makers, the banks, institutions, they take advantage of it by knowing and they're having idea where a lot of stop loss is going to be. And those stop losses to you are launching pads for them to place trades. So like we said here, I'm going to use this for example, just to illustrate. If I was buying here, my stop loss would be above, if I was selling, my stop loss would be above the range. If I was selling within that range, and I'll be looking to target the bottom of the range to take profit. The thing is, a lot of traders are doing that. They're putting their stop losses in that area. So this is what the market makers are seeing. They're seeing money in this area. So they see money there, see money here in those lines and based on those price levels. So above those support resistances, also on the bottom, they're seeing the same thing. People's stop losses from the ones that want to buy. People that are doing this. They're buying and they're placing their stop loss below the range. So when you see these ranges, or what I like to call equal highs and equal lows, you may have heard about those from the market structure training. Equal highs. And then here you have equal lows. Be very wary of trading at equal highs and equal lows, because most likely the markets are going to dip or exceed those levels to get into the areas where a lot of traders would place stop losses. This this money, these pockets of money or these pockets of stop losses to bigger banks is called liquidity. So both bottom and below, called liquidity. Now, what the market maker is going to do, whatever plan they have for the trend, they're going to keep looking for liquidity to help continue that plan. So if the markets are in a downtrend, use these. So the markets are in a downtrend like this. We fix that so it's much better. There we go. That's a little bit better. Then what the liquidity they're going to be looking for is the higher supply liquidity, or where people are placing their stop losses when they sell. So this area here is going to be of interest to them because they want to continue this downtrend. And the way they do that is by taking the market up to this point, capturing that liquidity and then making their big move down. They make those moves. Those moves are usually pretty fast moves. That way you can't really plan for it or catch or have a big window of opportunity to jump in on the move. So that's what's going on here. So if we look, it happens just about all the time. Here's the easiest example of that. So if I go here, let me actually clean this up. So easy way to spot it, right? Easy example to spot. You have here, you have the equal highs, especially when you have both equal highs and equal lows. You have that. Liquidity is sitting above that point. Look at what happens. The market goes into that area. Then from there, it creates its move back down. As you can see, it does it going two ways. You have this one capturing that equal high liquidity. And then even though this isn't perfect, that can be considered equal lows right here. So to create that move, and this is why the markets get a little bit confusing because they're doing this going both directions. So you see here equal lows, there's money sitting beneath here. And the market makers, they take that out to create that move going back up. And that move going back up takes this out to make it go back down. And that's happening over and over again. You can even use this, you can even use that as another equal high point. So this is another equal high. Even though it's smaller in the 1 hour sense of things, but money is money. There's equal highs and money sitting above that. You see how the markets, they go up to here to take that out in order to create the move down. So a lot of times these bigger moves are being created by the market makers grabbing liquidity. So when you notice that those big moves are made, see here, and not all, like I said, not all of them are going to be perfect, but you see that this fast little manipulation area was quickly reversed once it got to that level, created that move. That's not the cleanest example, but it still happened in that point. So that's why it's very important to understand that liquidity. It literally happens over and over again. And it doesn't just happen on the bigger time frames. It actually happens on the smaller time frames. You see here, I just open up the 5-minute chart. I automatically see this. This right here is equal lows. I can tell it's an uptrend. So equal lows here. There's money sitting beneath those equal lows in the forms of stop losses from people who are trying to buy. People are buying from this point. People are buying from that. And then you had a little bit of buying going on here. And what happens is this is a smaller time frame, so those stop losses are not going to be as large or as big as the bigger time frame, because these are scalpers. These are the scalpers of the market. So their stop losses are not going to be that high. But the market makers, they still dip down into that, below that equal low point, just enough to capture enough liquidity that they need in order to create that move going up. It even happens in the Bitcoin market, in crypto. A lot of people are like, oh, that's Forex. So zoom out. Let's look at it from a bigger standpoint. So it's kind of a few options I could use. Let's use this option. You have your equal lows here. And this is kind of like a double equal low or equal high move. This is how market makers confuse you, even if you know their plan. Like, they kind of do different things, but it's the same move. They just change the frequency of it. They got, your liquidity there, liquidity there. So they get into that liquidity before creating that move down. That sharp, see how that was a sharp move? So you have to capture liquidity to have a sharp move. But then the bigger move happened when they grabbed the liquidity here. Just above those equal highs, they grabbed that liquidity there and then created this sharp move down. And it just repeats itself. You see here, those little two highs, those are equal highs right here. So equal highs. And I can literally do examples of this all day. I can pull up any market at any random time, and in a decent amount of time, I can find an example of this. So equal highs, liquidity. This gets repeated over and over again. Market moves into that to create this move down. So that gives you your example of liquidity. So let's go on to the next aspect of things. Your institutional candle. So that's the manipulation, the liquidity grab. That's the manipulation, that price action manipulation to get into the liquidity zones. So as we go into here, those candles, you see here, it's usually the last, and this is the easy way to spot it. If it's a downward move, you can only spot liquidity institutional candles after the fact, unless you're very advanced and you can see it happening live. But you can only see it most of the time, see it after the fact. So let me clear this out so I can focus. I can easily show you the institutional candles. I'm gonna leave that there. So those institutional candles are usually the last opposite moving candle before a big major move in the other direction. So if I was to highlight that, that would be this bullish candle here. And let me zoom in so you can see it. So this bullish candle was the last significant upward candle. That candle breached more liquidity than the others because it reached the highest. Because, for example, if people had stop loss higher than that stop loss, so basically meaning something like this, and the most traders had a 37 pip stop loss from that point that were trying to trade it down, that candle was the candle that they needed to finally reach the level that they were interested in before moving the market in the complete and total opposite direction. So let me label it. That's your institutional candle. A lot of people, jokingly call it the FU candle, meaning that the market makers are, doing something to screw the plan of a retail trader. So you have your institutional candle here. Why? And this is an institutional candle, institutional candles, and the next segment, mitigation. See if I can find it. Here we go. So institutional candle and mitigation fall hand in hand. So we can go back to this level here. Because for a candle to be created, enough orders may be placed in that direction. So if it's a bullish candle, that means within that one, it's a 1 hour chart. Within the 1 hour, there are more buy orders placed, or a larger volume of buy orders placed than sell orders within that hour. That's what creates a bullish candle. A bearish candle, there was more sell orders than buy orders created to move the market down to create a bearish candle. So if the price of the market or the candle of the market was bearish, and that candle was the precursor, the preceding candle to the major move, here's what happened. This candle was the institutional candle. And think about it. If that candle was the institutional candle, what happened? That means market makers, banks, whatever firm wanted to capitalize on that liquidity, they bought into their own position. So in institutional candles, the institutional world, people or firms or market makers invest into their own position to create the conditions that they want to make their larger position. So meaning that if they're slightly short on the number of buy or sell orders needed to create enough liquidity to make their big order, they will provide the missing liquidity within themselves. So what happens is they place an order to be the final piece. So if, say, for example, what was already present in the market was 500,000 lots. And there's the firms, they place lots this size. 500,000 lots of selling, or this would be buy lots because this is selling stop loss. So buy orders by retail traders. So these money signs is equal to 500,000 lots of buy orders by retail traders. The institution wants, so the market maker or the institution wants to place a 700,000 lot sell order. But there's only 500 orders in the market. Delete that, put that there. But there's only 500, orders of buy orders in the market, and they want to place 700,000 sell orders. So there's 200,000 short from being able to place that 700,000 sell order. So what they do is they invest into their own position by putting whatever difference they need. So in this case, a 200,000 lot buy order to move the market into that position to where they would have enough liquidity to place their 700,000 lot sell order. So if you think about that candle and you're trying to find, and the whole idea of trading is institutional trading is trading with the big banks, the big players in the market, not trading against that movement, trading with them. It's a lot simpler. Then your whole job is to figure out where they would place an order. So if you have evidence that an order was possibly placed in that aspect, what area of that candle are you looking at to be lined up with where the order was? Is it the close of a candle or the opening of a candle? It would be the open of a candle, because the opening of the candle represents where those orders were placed. So what you do is you basically make a line at the open of the candle, and that is your institutional point of interest, your mitigation. And I'm going to show you what mitigation is with that point. So we fast forward. The institution is able to place that 700,000 lot sell order. They're able to place that order, causing the market to shift in the other direction, that causing a domino effect of a sell leg, or a leg of the market going down. Here's the kicker to what they just did. They have to leave this 200,000 lot buy order that they placed in this bullish candle. They have to leave that order open. So they can't close that order. So the 200,000 lot buy order, they can't close it because they have to let that stay there for the liquidity of the sell that they just placed. So what's happening is they're profiting on the bigger trade by the market is going down, because that was a sell order. But they're actually in drawdown from their institutional mitigation, their institutional candle order, meaning on this candle. So they're in drawdown. The difference is they have unlimited money, so they can take the drawdown. But of course, they're not going to take the loss on it. They want to break even or get back, so let the markets get back to a point where they break even. So they're going to hold that order open. When the market returns to that level, so when the market returns to that level, they close the order, thus causing another institutional market reaction. So you see how that shift lined up with that candle, while simultaneously lining up with more retail liquidity in these equal highs. So this is how the markets align up in institutional trading. So I taught you the psychology aspect. This is the mitigation of it. So they get to that point where they can close out their buy order. And to close out a buy order, what do you have to do? In the real market terms, you have to sell. So to close out a buy, you have to sell. So what's happening is they're equaling out their buy. They're breaking even by selling at that level to close out their position. And that sell causes the shift back down. So a lot of you, especially at this point, might be like, man, this is a lot to know. So I'm going to show you the easier way. I want you to understand why this works. If you understand why it works, then now you can just focus on how to trade it. And you can just remember how to trade it And this long part of what all these explanations I just gave will help you understand why, so you can just focus and have faith in how you're trading it. So let's go back. So that's basically mitigation. And you're going to see this, for time's sake, I can't go into too many examples where you're going to see that happen a lot. The other form of somewhat mitigation is not the same scenario, is imbalance. So imbalance happens when the market does something like this. Let me close this out. Let me do a clean example. Let's get off of this chart. Let's do something different, just so you can see it better. See if I can find an easy example. Okay, perfect. So, imbalance. Imbalance is basically are like gaps in the market, but not like the gaps you're accustomed to seeing where you have a candle that moves up like this, it closes, and then there's a candle that jumps up like that. Now, those are the traditional gaps that you're used to seeing, where there's a gap between the close of a candle and the open of the other. That's not the gap that I'm talking about. This is the imbalance gap is more of a market maker gap. And meaning is market makers, they're trying to balance the market. They're always, it's just think of the whole Forex market like a checkbook or, accounting. They're trying to balance out the buys with the sells. So when you have areas in the market that are just one-sided without any other check to it, so you have this area here, without any other check to it, this here is called, your imbalance. When you have, and I'm gonna show you an example of balance. So when you have the markets do something like this, where you have, upward movement, candle breaks out, goes into a new part of the market, and then there's a corrective move to balance out that last movement. That's a balanced market. Upward movement, corrective movement. But when you have a point in the market where there's just movement and there's no corrective movement or retest, that's imbalance. To be more, I guess, advanced in imbalance is specifically when you don't have anything coming back into it. That means wicks too. So like if I use this, for example, this previous move up, this candle created imbalance. But as you can see, that entire candle move was balanced back out by price moving back into that level and this wick closing the final parts of the imbalance. You see here that imbalance is left alone here. So move that out. So imbalance goes imbalance there. You see where these wicks are not, there's no corrective moves, no wicks coming down to balance that out. So all through here is imbalance. And the market makers want to close these imbalance points. So when you see the open areas, open spots in the market like that, where it's just price movement going in one direction, know that when the market moves in that direction, it's going to be more like a magnet in that direction. So what you would see and notice that happens is it won't happen immediately, because remember, market makers are not impatient like retail traders. They can wait on their moves. So they move, market moves away, continues to move away, continues to move away, and then it captures most of the imbalance before making its big move back up. And sometimes it'll go back and capture more of that imbalance like it's doing now. Getting into all the areas of the imbalance, and most likely what you'll see from that point, since that most of the area of the imbalance is closed, they'd be satisfied enough to push the market back up. So with imbalance, think of it like that magnet. Now, here's how you trade imbalance. Here's how you trade it now that you know what it is. And now that you see it, you can probably start seeing other areas of imbalance being closed and acted upon. So you see this area here used to be imbalanced and price moved back into it. You know, and usually when imbalance is closed, it causes a market reaction, causes a reaction. Doesn't change the trend. You know, it doesn't guarantee that you're going to have a large move that comes from it. Just tells you that there's going to be a reaction in that level in the other direction. So I like using imbalance levels as potential levels to place trades. You know, imbalance levels and mitigation levels, meaning the last candle before a movement. So if I look here, and that would be this bullish candle there. I mean, that bearish candle there. The open of that candle was a clean movement. It didn't happen as much in that area, but even the imbalance itself, basically created enough of a reaction to be a profitable trade. So, you know, this failed move was still how many pips? 70 pips. So if you could take 70 pips in the market off of a failed move, I think you'll be a very profitable trader. That's imbalance. You know, it's just finding those points like that. They're not going to work all the time, but they're going to create good points in the market where you can look for placing your trades. One trick with imbalance, say you have a large pool of imbalance and you don't know where exactly to place your trade. A good rule of thumb is to take all of the imbalance and use a Fibonacci. So use a Fibonacci point. And what you want to do is you want to trade the 50% level of the imbalance. So for me, that's the 50% level. So what happens is price gets down into that level, that area, and then creates market movement back up. So that's a good rule of thumb. We have a large amount of imbalance. All right, let's get into the last part of our lesson, and that's finding how to trade these institutional points. So the institutional entry, stop loss placements, and then how to basically combine market structure with institution, which is one of my favorite ways of capitalizing on the market. Let's get right into it. Let's go to a different chart just to make it a little bit cleaner. So we talked about a few things. We talked about, you know, the imbalance. We talked about liquidity. Talked about mitigation. A lot of different aspects of trading, supply and demand. I know those are a lot of different terms thrown at you in explanation of terms, but here's how we're going to make it simple, right? So you have, let's say, you know, you're looking for, you know, your institutional trades, and you have, you know, your downtrending market. We talked about the scheduled sessions with consolidation, Asian session, but this is how it mixes in with institutional trading. So what I talked about is that usually some form of institutional move happens to create the larger legs in the market, because the institution is what drives the markets to create large movements. So what you normally see, and we talked about the mitigation point, that last opposite moving candle before the bigger move. Here's how you combine it. This is, and we talked about everything that we talked about just to get here. So pay close attention. So this is a downtrend. So you have your bullish candle. You switch the color. So you have your bullish candle here, your downtrend. On your downtrend, market's moving down. Remember, you're buying low, selling high. That's the market structure term. And then, you know, you have your confirmation, you have your institutional candle, that mitigation candle whatever you want to call it. It's kind of all interchangeable terms. And then you have your market moving down, shifting down after this aspect of things. So your buy to sell, your sell to buy. The institutions place their investment into their own position. Now that they've confirmed their entry in the market by creating a large candle, you have your movements down. So what you're waiting on is the market, because remember, they have this position open at the open of their FU, their candle, their institutional candle, that last candle before the major shift. They have their buy order open. So they want the markets to come back to this point. So all you're looking to do is trade the markets at the next high point that lines up with this area. This area here that lines up with that area. And you're going to continue to trade it down. What would normally happen is this repeats itself here. So you have your bullish candle. And then followed by your bearish candle, which is your confirmation that the institutional move happened, that large bearish candle. You're just simply waiting on it to repeat itself. So you're trying to walk the market down using institutional areas and entries. So remember we talked about earlier, we're using this diagram, those equal highs, liquidity being up here. So I like it when these things combine at the same point. You're finding confluence, but you're finding institutional confluence instead of retail trading confluence, like, oversold of RSI, stochastic at the same time with Bollinger Band. Those are retail confluences. This, what I'm showing you now, is institutional confluence and confirmations. So you have multiple things happening. So you have a mitigation in effect. The market makers are waiting on that market to get back to their break-even level. So we're now looking at this level here to potentially sell. That sell level is above a equal high, which represents liquidity in this area. So all that's happening at the same time. So when the market does that, and let's say as well, let's put a perfect storm for institutions. Let's say as well that that area also is an imbalance zone. So you have, imbalance, meaning that there was a gap, there wasn't a retest in a certain area, which is this area here. The markets didn't retest it, it created a gap and then continued its downtrend. So let's say all those things are happening at the right time at the same area. This is what you want to look for. So you want to look for the market to make its move up into that area, capturing that liquidity, closing out the imbalance that's here, and getting to the area of mitigation for the market makers. That is the perfect entry for, and within trend, of course, that is the perfect entry for institutional trading to take the market down. What you're looking for as far as your position, you want your position to be at the open of that, mitigation candle, that institutional candle. And you want to place your stop loss above the high of that candle. And this is a sell, so you want to place it above the high of that mitigation candle, which is this candle here. And then from there, you want to, I usually target, 2 to 1, 2 to 1 a risk, reward to risk, or 3 to 1 reward to risk from whatever I'm risking. That's what you're looking for. And you're looking for that move on an uptrend. It's the same way. The more you have in your arsenal as far as confirmations, the stronger the trade will be. So this is the basic plan, the schematic of how you want to look for your trades. So let's see if we can find some examples in the real life market. And right away, find an example. So right here, we got an uptrend. The market moved from bottom left to upper right. I see right away that this is my institutional candle. You see how the market dipped in, created that breach of that last equal lows. You see how these closed all in the same area. On a smaller time frame, those are equal lows. This is still an equal low on the bigger time frame, but it'll show more on a smaller time frame. As you get better at identifying that, you'll see that quicker. That's my institutional candle. Market moves up. Market moves up, and equal lows are created here. Equal lows are created here, meaning liquidity is there. So what happens, the market dips down into that area. You notice how where this area is literally by that zone. Sometimes they're going to get close to it, but not fully hit it. It's completely fine. It happens. But you have that area where the market then continues upwards. It does it again. You have your last candle, your institutional candle, dip down that wick, dip down to create, liquidity. It wasn't a perfect equal low, but this doji hammer candle right here is still your institutional candle. You place your area where you want to buy at the open of that candle. You see how this created, this is the last major bullish candle before that shift up. You created that. You see here, there's equal lows created. Equal lows created, liquidity in that area. All of that happened at the same time. Market goes into here, very little drawdown, and it goes upwards. Then, if you think about it, the entry for this entry also is a institutional candle for a future entry. They like to chain their moves like this. So you repeat the same thing. Open up that institutional candle. This time is equal lows being breached, institutional candle, and this time there's imbalance right after the move. You see how the different plays like to play out. You're not going to get everything at the same time, but you're going to get multiple components of institutional trading happening in the same moments. Got it. Equal low. You also have equal lows here. You also have equal lows here. And liquidity within the imbalance. I love when that happens. Equal lows going into an imbalance. I love that confirmation. And then the market dips down into that area and continues forward. Now, of course, it didn't make a new high, but think about what the goal was as far as your trade. Remember, my stop loss is a little bit below that institutional candle, what I believe it is. And my goal is 3 to 1. Even though it didn't even create a new high, and some people would consider this a failed move, it created a 4 to 1 opportunity within the markets. So I don't think that's a failed move at all. I got what I was looking for out of it. This is how you should think as well. So if you can create situations where 2 to 1, 3 to 1, 4 to 1 reward to risk, meaning that for every dollar, like in a 4 to 1 example, for every dollar you're risking, you're looking for $4. If you could create that and the market don't even have to act completely right for you to get it, then you're putting yourself in a great position. Even here, the next move down. So the next move, this candle here was the last significant candle, that bearish candle before this upward shift. This is not the best upward shift to use because it didn't create a new high, but it's still an upward shift. You want ones that create new highs or new lows. Those are the shifts you want. Those are the best ones that you want to trade off of. But still, the rules worked out. You had your open of that candle, here you have your equal lows. You have your equal lows, some liquidity in here. Now, this is a smaller move, so it's not going to be that much liquidity. But still, even in this imperfect sequence, you still have a decent position line up. Your entry there, stop loss below the candle, and very imperfect sequence still creates a 2-to-1 reward to risk opportunity. That's a very imperfect sequence. If you wait a little bit longer, it would have went higher, but we're not going to always get everything you want right away. But this is the move. This is what you're looking for. We're in an uptrend. There's a shift here. Does this create a new high? No, it doesn't create a new high. Oh, wait. So this one, let me zoom out so you can see it too. So this move here creates a new high. So this leg up creates a new high. Let's delete things for now. So a new high was created with this movement up. So think about your mitigation candle. This is the last candle before the big up move. That's that candle. I'm gonna put it right here. You see that there's some imbalance. You see that it's tight, a little bit imbalance, but that right there is imbalance. The market didn't come back down to balance out that upward candle. So my imbalance there. Then I have areas of equal lows. Right there. Meaning, and they span across a few days, meaning that there's a lot of liquidity and stop losses in that area. Market dips down. Market dips down to that area. And we're still waiting to see what happens. This is the live market. But you see that it was still a reaction in that area. It was still a reaction. It still went up, even though it's not even complete. It still went up. Gosh, what, 40 pips from that point? So right here, 56 pips. So your very imperfect trade. Let's see if you got 2-to-1 just off of what already happened. Here, stop loss below the candle, never touch stop loss. Below that candle, it got close, never touched it. So roughly 30 pips. So right at 2-to-1. That's still a winning trade. So this is what you're looking for. It happens over and over and over again. So the more you're able to spot this on different charts, the more dangerous you are with trading institution. And I hope that this gives you a great sum of value to be able to trade the markets using institutional methods.